Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two dividend-paying stocks to consider buying before their upcoming earnings releases to help combat the current market volatility and the current economic environment. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we get into everything, I want to just quickly dive into the broader market to help give some context for these two stocks we're going to talk about today. So last week, the market reacted pretty negatively to March's 8.5% inflation data, which marked another 40-year high. The moves lower came on the back of expectations now that the Fed will be forced to raise the rates even more quickly and perhaps at larger 50 basis point chunks instead of the 25 basis point hike that they did the first time, while shrinking their balance sheet as well. And this is going to be something that seems like they're going to be forced to do in order to tamp down these soaring prices. The likelihood of a more hawkish Fed is forcing the market to give up a decent amount of those recent gains since the end of March. The market was initially pleased by the Fed's decision to lift their core rate by just 25 basis points, but the days of playing it safe and taking it slow, even amid the Russian invasion of Ukraine, just might not be able to last. So with that said, the S&P 500 is now back down around 8.5% from its highs, with the NASDAQ down around 17% from its highs, with both back under the 200-day moving averages. In fact, the NASDAQ's now met resistance at that key level twice, once on March 29th and then again on April 4th. So market's trending back down in the wrong direction again in the yield. Meanwhile, in the 10-year U.S. Treasury is hovering at around 2.85% at the moment. It closed last Thursday at its highest levels since December of 2018, and it's up about a half a percentage point in April alone. So with that in mind, even though rates are still really high in terms of where they've been over the last several years, if we look over the last decade, we've been up above 3% a few times, and we've hovered around these levels between around 1.5 to 3% over the last 10 years. And then we're still really historically low if you look pre-financial crisis. So if we look back, say around 2007, we were at about 4.5% for the 10-year U.S. Treasury, and that was low compared to where we were everywhere before the early 2000s. So we're still historically low, and despite some setbacks, the overall earnings picture for 2022 and beyond appears strong, even though some revisions are trending in the wrong direction. And we saw the big banks start reporting their first quarter results last week, and they've been setting some money aside for some potential loan losses with the economic certainty looming or continuing and rising prices continuing as well. So with this in mind, the near-term outlook for Q1 and Q2 is not necessarily the best in terms of earnings. They're also coming up against really hard to compete against periods. But if we look out on the annual picture, we're calling for S&P 500 earnings for 2022 to climb 7.9% total, which would come on top of 50% growth the year before that, which obviously came against an easy to compare 2020 with COVID. And then we're calling for 6.1% revenue growth. And then in 2023, we're calling for 10% adjusted earnings growth on 5% higher revenues, and then 8.2% earnings growth in 2024 on 5% higher revenues as well. So some sustained 3 years of solid top and bottom line growth on top of a big blockbuster 2021 is what we're looking at for the long term, even though the near term is looking a little less bright day by day amid the current economic turmoil and the rising energy prices and rising prices in general. So with this all in mind, Wall Street might still be trying to chase returns in stocks to try to beat that 8% and higher inflation. And one of the first stocks we're going to look at this week of the two is NextEra Energy, which is set to release its first quarter fiscal 2022 financial results before the market opens this Thursday, April 21st. So we're just going to go through some basics and then dive into why investors might want to take a look at NextEra Energy. So NextEra, through its various subsidiaries, is one of the country's biggest electric utilities and a leader in renewable energy, boasting that it is the world's largest producer of wind and solar energy. Crucially, given the variability of wind and solar, NextEra Energy, which I think I mentioned trades under the ticker NEE, N-E-E, is also a global leader in battery storage, and NextEra generates clean, emissions-free electricity from 7 commercial nuclear power plants as well. Nuclear, which currently accounts for about 20% of U.S. electricity generation, is gaining steam as more countries from China to France invest heavily to help reach a carbon-neutral clean energy future. Plus, renewable share, which does not include nuclear if you're talking about what we're considering renewables in this broader scale. U.S. electricity generation is projected to soar from 20% in last year to 40% all the way by 2050, with wind and solar being the biggest gainers. So clearly, these trends with nuclear, wind, and solar are set to benefit NextEra for the long haul and in the near term. The company is coming off 2 slightly down years that saw its revenue decline year over year. NextEra Energy's outlook, though, is strong, having added 7,000 net megawatts of renewable energy and battery storage projects to its backlog in 2021. So Zacks estimates are calling for its 2022 revenue to surge 36% this year, which would blow away its 2019 levels, which is coming after those back-to-back declines, at $23 billion, which would come in well above the $19.2 billion it pulled in 2019, and then climb another 8% next year in 2023. And then at the bottom end, its adjusted earnings are projected to climb 10.2% this year, and then another 9% in 2023. And this would come on top of 10% adjusted earnings growth last year in 2021. The company has also consistently topped our quarterly earnings estimates. We should note that its FY 2022 and FY 2023 consensus figures have inched higher recently, though it still lands a Zacks rank number 3 hold at the moment. Meanwhile, 6 of the 8 brokerage recommendations Zacks has for NextEra are strong buys, with nothing coming in below a hold. And the firm lifted its dividend payout by 10% year over year for an adjusted yield of about, or not adjusted, for a yield of about 2.07 at the moment, so about 2.1% at the moment. NextEra Energy shares, in terms of their performance, have been up about 180% in the last 5 years. This blows away its industry's 45% climb, and the S&P 500's 115%. This impressive outperformance also stretches out over the past decade, with NextEra up 580% versus the benchmark's 333% climb. So this helps put its 2.1% dividend yield and even more impressive at the moment, considering that the stock is hardly beaten down over the long haul or anything like that. The company's also roughly tracked the benchmark over the last year, up around 5%. And as of Monday morning, it was trading around $82 per share, or about 12% below its late December records. So it's a solid price point, possibly for longer-term investors. The stock's also trading at a 20% discount to its own highs at 28.7 times forward 12-month earnings, which places it right around its 3-year median as well. So its valuation is shaping up nicely, given its slow decline in 2022, coupled with its strong earnings outlook. So therefore, investors with longer-term outlooks might want to consider NextEra Energy to help combat the current market environment and possibly hold it for the long haul as part of a nice diversified portfolio. Now, the next stock we're going to talk about is Verizon, which trades on the ticker VZ. The company is set to report its first quarter 2022 earnings results on Friday morning, April 22nd, so this upcoming Friday. Verizon is currently the country's largest wireless network operator in terms of subscribers. Verizon is rolling out its next generation wireless network alongside AT&T and T-Mobile. They're all currently working to implement and expand their 5G networks. All of the networks are relatively small, despite the broader and sometimes hyperbolic marketing pitches. The company entered 2022, though, with significant 5G adoption and fixed wireless broadband momentum, now covering more than 95 million people in the U.S. with 5G ultra wideband. And this is according to Verizon. Verizon also said that about a third of its core customer base had already upgraded to a 5G capable phone. The company also last year committed to pay about $53 billion for licenses and associated auctions cost to secure C-band airwaves, which are helping for that 5G strategy going forward. Verizon and AT&T and others have also faced pushback from U.S. air safety regulators in recent months as they try to expand that 5G or fifth generation network. You can look into those stories. We're not going to get into all of that at the moment in terms of air safety in these 5G networks, but the essential push for 5G is they provide faster internet speeds and more network capacity, and just faster. Faster is the key word there. So with all that said, investors should note that the implementation is really capital intensive, which might favor Verizon in the long run because it has not taken on as much debt to fuel expansion into new industries like AT&T. And even before the pandemic, Verizon was focused on some cost-cutting efforts. With that said, they've also, though, recently, in the last 2 years, decided to expand a little bit. So Verizon bought cloud video conferencing firm BlueJeans in April 2020. The move helps it expand into the remote work communication space alongside Microsoft, Zoom, and others. And then the company this past November closed its $6.3 billion purchase of prepaid cellular service provider TracFone, which is helping cement its lead in a market that's split among the three major cell phone networks. So TracFone had about 21 million prepaid customers in the US under its core namesake brand, as well as Straight Talk, Net10, SafeLink, and some other lower priced carrier names. The company doesn't run those companies, so TracFone doesn't run its own physical networks in the US and instead relies on other cell phone carrier systems for a fee and then resells that service under its own brand. So that's now part of Verizon. That deal also helped to subsidize some revenue after Verizon in 2021 decided to sell most of its AOL, Yahoo, and other digital media properties to private equity firm for about $4.3 billion. That said, Verizon did keep a 10% stake in its online unit. In the fourth quarter, its total wireless service revenue climbed about 6.5% year over year. It added 1.1 million retail postpaid net additions, including 558,000 phone net additions, which resulted in, as the company said, 143 million total retail connections. So overall, though, its quarterly revenue slipped about 1.8% in the fourth quarter, which reflected its divestiture of its media business. Still, overall, the company's revenue climbed 4.1% in 2021, which came on top of 2.7% decline in 2020. And meanwhile, its adjusted earnings climbed 10% last year as well. So overall, Verizon said that its total connections, which is a figure that includes connected devices like smartwatches and tablets, but excludes phone services resold through partners like Charter and Comcast, ended the year with 115.4 million. That reflected that new 20 million, roughly 20 to 21 million additions that TracFone customers added to Verizon's total figure. So Verizon's still the number one player. That's ahead of T-Mobile and AT&T in that TracFone addition helped it really stand out among those peers. So if we're looking ahead to 2022, Zacks estimates are calling for its revenue to climb about 2.3% this year to $137 billion and then climb another 1.4% next year. And then on the bottom line, we're calling for about a 0.75%, so about a 1% climb this year on the bottom line, and then another 2.7% jump in 2023, all the way up to $5.58 per share. That said, the company has seen some mixed earnings estimate revisions recently, trending down in the wrong way for the first quarter results that it's going to report later this week. But the rest of it, the results or estimates have been pretty stagnant over the last couple months, with the stock coming in as a Zacks ranked number 3 hold at the moment. We should also note that the company has a strong history of quarterly earnings beats, including 4 straight beats. And then in terms of stock price performance, VZ shares are up 37% over the last 5 years to outpace its industry's 23% climb. And then if we look over the last 2 years, Verizon is up just about 1% compared to its industry's 11% decline. So it's started to lag that space over the last 2 years. It's currently trading 9% below its 52-week highs at around $53 per share and 65 cents. So around $53 $53, $54 a share the last time I checked on Monday morning. With this in mind, the pullback has the stock trading at right around 5-year lows in terms of forward 12-month earnings. So it's trading at 9.8 times forward 12-month earnings, which marks a solid discount to its industry's 10.9 times forward average. And then it comes in well below its highs over the stretch. It's traded as high as 14.2 times in the last 5 years, and it's well below its median of 11.7. So trading at solid discounts to where it's been over the last 5 years, given this recent pullback. And right now, its dividend yield is also sitting at a really strong 4.8% right now, which is well above both the S&P 500 average, the 10-year U.S. Treasury, and the 30-year U.S. Treasury. So some solid dividend payout for investors looking to try to beat some inflation. With that said, Wall Street's sort of mixed on the stock. There's no sell or strong sell brokerage recommendations that we have, with 4 strong buys, 2 buys, and then 11 holds. So most of Wall Street's saying just hold on to the stock. They're not super bullish, but they're also not bearish on the stock at all at the moment. So VZ is currently a Zacks ranked number 3 hold. I think I might have mentioned that just a little bit earlier. And investors with longer term horizons might want to consider the stock for its ability to steadily, slowly expand within an industry that's not going anywhere, and its ability to pay that solid dividend yield. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.